The decision to buy a home or continue renting is one of the most significant financial milestones you will ever face in your adult life. Most people treat this choice as a simple comparison between a monthly mortgage payment and a monthly rent check, but the reality is far more complex than a basic line item on a budget. When you approach this crossroads, you are not just choosing a place to sleep, you are deciding how to allocate your largest pool of capital for the next several decades. For example, many people rushed into homeownership in the early 2000s because they believed prices only went up, only to find themselves underwater when the market shifted. Making the wrong choice can anchor your finances for years, while the right choice can act as a powerful engine for wealth creation. Understanding the deep mechanics of this decision is the first step toward achieving true long-term financial independence. One of the most overlooked factors in the rent versus buy debate is the opportunity cost of your initial capital. When you buy a house, you typically lock away a substantial down payment that could otherwise be working for you in the liquid financial markets. If you invest $100,000 into a diversified index fund rather than a down payment, the historical power of compounding interest could potentially outperform the appreciation of a single piece of real estate over time. For instance, a tenant who rents a modest apartment and diligently invests the difference in a brokerage account may end up with a higher net worth than a homeowner whose wealth is entirely tied up in their primary residence. You must recognize that every dollar spent on a home deposit is a dollar that is no longer earning a return elsewhere. Evaluating where your money works hardest is essential for a professional approach to your portfolio. There is a common misconception that renting is simply throwing money away while buying is always building equity. In reality, both renting and owning involve significant unrecoverable costs that will never be seen again. When you own a home, you are paying for property taxes, homeowners insurance, and mortgage interest, none of which contribute to your ownership stake in the property. Consider the first 10 years of a 30-year fixed-rate mortgage, where the vast majority of your monthly payment goes toward interest rather than the principal balance. This means that for a long period, the homeowner is essentially renting money from the bank, just as a tenant rents space from a landlord. Realizing that both paths involve sunk costs allows you to make a more objective comparison based on the actual numbers rather than emotional slogans about throwing money away. To simplify this complex comparison, many financial experts recommend using the 5% rule as a quick heuristic for decision-making. This rule suggests that the annual unrecoverable costs of homeownership usually hover around 5% of the total value of the home. This includes 1% for maintenance, 1% for property taxes, and roughly 3% for the cost of capital. For example, if you are looking at a $500,000 house, your unrecoverable costs are approximately $25,000 per year, or about $2,000 per month. If you can rent a similar home for significantly less than that monthly figure, then renting is mathematically the superior financial choice in that specific market. Using a clear mathematical framework helps strip away the bias and focuses your attention on the raw economic efficiency of your living situation. The true cost of homeownership often remains hidden until something major breaks and you realize there is no landlord to call. While rent is the maximum amount you will pay for housing each month, a mortgage payment is merely the minimum amount you will pay. Homeowners are responsible for every leaking roof, failing furnace, and cracked foundation that occurs during their tenure. For instance, a sudden failure of a central air conditioning system can easily cost $10,000, which is an expense a renter never has to worry about. These maintenance costs typically average out to 1% of the home value every year, and they can drastically reduce your actual return on investment. Budgeting for these inevitable expenses is the only way to ensure that your home remains a financial asset rather than a liability that drains your savings. One of the greatest advantages of renting is the high degree of mobility and career flexibility it provides to the modern professional. In a global economy where the best job opportunities might require moving across the country, being tied down by a physical asset can be a major strategic disadvantage. If you receive a job offer that pays 50% more but requires a relocation, A renter can simply wait for their lease to end or pay a small break fee to move. A homeowner, however, must deal with the lengthy and expensive process of selling a property before they can fully commit to a new chapter. This flexibility allows you to chase higher income levels and diverse experiences without the friction of a real estate transaction. Prioritizing your ability to move quickly can often lead to greater lifetime earnings than the slow appreciation of a single house. Transactional friction is a silent killer of real estate profits that many first-time buyers fail to calculate properly. The costs associated with buying and selling a home, such as agent commissions, closing fees, and title insurance, can easily eat up 10% of the total property value. If you buy a house for $400,000 and sell it 3 years later for $440,000, you might think you made a profit, but the transaction fees will likely leave you with less cash than you started with. This is why real estate is traditionally viewed as a long-term play that requires a commitment of at least 7 to 10 years to break even on the initial costs. Unless you are certain that you will remain in the same location for a decade, the high cost of entering and exiting the market makes renting a much safer financial bet. While renting offers flexibility, homeownership provides a powerful hedge against the rising tide of inflation over the long term. When you secure a fixed-rate mortgage, your largest monthly expense is locked in for 30 years, even as the value of the currency decreases and wages generally rise. Imagine someone who bought a home in 1995 with a fixed payment of $800, which might have felt expensive then, but feels incredibly cheap in today's economy. While the cost of rent continues to climb every year in line with inflation, the homeowner's debt remains static, allowing them to pay back the bank with dollars that are worth less than when they were borrowed. This creates a scenario where your housing costs, as a percentage of your income, naturally decline over time. Leveraging a fixed-rate mortgage can be a brilliant way to protect your future purchasing power from the volatility of the rental market. Beyond the spreadsheets and interest rates, there is a profound psychological component to owning the land where you live. For many families, the stability of knowing they can never be evicted by a landlord is worth more than any potential stock market gain. Ownership allows you to customize your environment to fit your exact needs, from painting the walls to renovating the kitchen, without asking for permission from a third party. For example, a family with young children might value the security of staying in the same school district for 12 years without the risk of a non-renewal of their lease. This sense of permanence and control provides a level of peace of mind that is difficult to quantify, but very real in terms of quality of life. You must weigh your personal need for autonomy and stability against the pure financial metrics of the rent versus buy equation. The tax code in many countries is heavily slanted in favor of homeowners, offering incentives that can change the math of the entire decision. In many jurisdictions, you can deduct mortgage interest from your taxable income or enjoy significant capital gains exclusions when you eventually sell your primary residence. For instance, if a couple sells their long-term home for a $500,000 profit, they may be able to keep the entire gain without paying a single cent in capital gains tax. A renter who makes the same profit in the stock market would typically owe a significant percentage of those gains to the government. These tax advantages act as a government subsidy for homeownership, effectively lowering the real cost of owning compared to renting. Understanding the specific tax laws in your region is vital for calculating the true net return on your housing investment. It is a dangerous mistake to treat your primary residence as a speculative investment or to try and time the housing market. Real estate is a highly illiquid asset, and trying to flip a home for a quick profit is a strategy reserved for professionals with deep pockets and high risk tolerance. Most people should view their home primarily as a place to live and a forced savings vehicle rather than a shortcut to getting rich. If the local market enters a downturn, you might find yourself unable to sell or refinance, which can lead to financial paralysis. For example, many people who bought at the height of a bubble found themselves trapped in homes they no longer wanted because they owed more than the property was worth. Focus on whether the home meets your lifestyle needs and fits your long-term budget rather than gambling on short-term price fluctuations. A home is often a highly concentrated asset that can leave your portfolio dangerously exposed to the risks of a single geographic location. If your entire net worth is tied up in a house in a city where the main industry suddenly collapses, you could lose your job and your home equity simultaneously. Diversification is a fundamental principle of high-end finance, and renting allows you to keep your wealth spread across various global sectors and asset classes. Consider the residents of once booming manufacturing towns who saw their home values plummet when the local factories moved overseas. By renting, you avoid the risk of having too many eggs in one local basket, which protects you from hyper-local economic shocks. Maintaining a diversified portfolio outside of your housing choice ensures that your financial survival does not depend on the fortunes of a single zip code. Deciding whether to buy or rent is not about following a universal rule, but about aligning your housing choice with your career stage and financial goals. We have explored the opportunity cost of capital, the reality of sunk costs, the benefits of mobility, and the hidden expenses of maintenance. Whether you choose the flexibility of renting or the long-term stability of owning, the key is to make the decision based on rigorous data rather than social pressure. If you found this deep dive into the economics of housing helpful, please hit the like button and subscribe to the channel for more high-end financial education. We would love to hear your thoughts in the comments section below regarding which factor matters most to you. Are you prioritizing the flexibility of renting or the inflation hedge of a mortgage in today's economy? Thank you for watching, and we will see you in the next analysis.